Welcome to Group Insurance Daily Pulse, your rapid-fire download of the most critical developments impacting our sector. I'm Aria the Actuary, ready to dissect the actuarial implications and regulatory headwinds.
And I'm Dorian the Distribution Expert, here to highlight the market opportunities, technological accelerants, and strategic plays driving growth and enhancing employee experience. Today we're talking targeted offerings, AI integration, regulatory shifts, and evolving employee benefits. Let's dive in. Kicking us off, hot off the wires from June 9th, USAA Life Insurance Company has strategically enhanced its final expense coverage, rolling out USAA Secure Final Expense Whole Life Insurance. This isn't just another product, it's a precisely targeted solution for their core demographic, military families. Available for individuals aged 45 to 85, with coverage from $5,000 to $40,000, it directly addresses a critical financial need. End-of-life expenses average over $8,300 for burials and $6,300 for cremations, starkly contrasting with the typical $255 Social Security death benefit. The kicker? It includes an Eagle Plus rider, offering a complimentary digital estate plan through Trust and Will. For carriers, this is a masterclass in market segmentation and value add.
Brokers gain a comprehensive, specialized product, and employers with a significant veteran workforce can leverage this as a unique, holistic benefit for financial well-being. It's a clear win for market penetration and customer loyalty. Masterclass in market segmentation, Dorian, or a masterclass in adverse selection risk management. Let's unpack the actuarial implications here. Guaranteed issue whole life for ages 45 to 85 immediately flags mortality assumptions. While military families may exhibit specific mortality characteristics, the broad age band and guaranteed issue nature necessitate robust morbidity and persistency models. What is the expected mortality arbitrage within this demographic? How are they pricing the tail risk on the older cohort? The $5,000 to $40,000 coverage range, while addressing the average final expense, is relatively low, which can mitigate large claim exposure but amplifies the impact of administrative costs relative to premium.
Aria, the value proposition is undeniable. Organic growth is excellent, Dorian, provided the product's long-term loss ratio and administrative expense ratios are sustainable. The regulatory landscape for bundled products is tightening, and we need clarity on how state insurance departments are interpreting these innovative riders. Solvency isn't built on perceived value alone, it's built on sound actuarial pricing and robust risk management.
Point taken, but the market is moving towards integrated solutions.
And the regulators are watching closely. Pivoting to a major technological shift. And this is a dual segment because two key pieces of news from the last 48 hours demand a unified discussion on AI. First, on June 9th, Integrity LLC, a leading distributor, announced a partnership with Alfary Group, an independent marketing organization. Alfary will leverage Integrity's AI-first platform to expand its offerings into life, health, and wealth services. This is monumental, Aria. It underscores the accelerating trend of AI-driven platforms becoming central to distribution strategies. For carriers and TPAs, this means enhanced efficiency, hyper-personalization, and a superior customer experience in selling complex products. For brokers and IMOs like Alfary, it's about competitive advantage, delivering holistic solutions and scaling operations like never before. Intelligent is the operative word, Dorian, and it brings me to our second critical AI development. Covenir's 2026 Insurance Operations Leaders Trends Report, released yesterday, June 10th. This report, based on a survey of 152 U.S. insurance operations decision-makers, reveals a deeply concerning disparity. While 70% of organizations now have AI running in live operations, a significant jump from 58% a year prior, a staggering 20% of these organizations are simultaneously cutting training budgets for AI. Only 7% are protecting them. This is a red flag for operational risk, P&L stability, and potentially solvency.
Aria, while I acknowledge the training budget concerns, the sheer pace of adoption, 70% in live ops, demonstrates an industry-wide commitment to leveraging AI for competitive advantage.
Dorian, intuitive does not equate to risk-free. The technical debt accumulated from underinvesting in human capital for AI oversight is a significant P&L exposure. We are talking about models that influence pricing, claims adjudication, and regulatory reporting. Model drift, algorithmic bias, data privacy breaches, these are not theoretical risks. They are material solvency threats.
The DOI is increasingly scrutinizing AI use in insurance, particularly concerning fairness and transparency. An AI-first platform is only as robust as the governance framework and the skilled personnel overseeing it. Without adequate training, the 88% optimism could quickly turn into an 88% crisis when an AI system makes a costly error or triggers a class action lawsuit for discriminatory practices. The efficiency gains are moot if they're offset by remediation costs, reputational damage, and regulatory penalties. We're automating complexity, not eliminating it. But the market demands speed and personalization. AI delivers that.
And the market also demands stability and compliance. The current trajectory suggests a concerning imbalance.
Shifting gears to a significant regulatory development in the health insurance landscape, CMS issued a final rule on May 15th, published June 9th, allowing health plans without a provider network, non-network plans, to be certified as qualified health plans, QHPs, on the Affordable Care Act ACA marketplaces. This structural change is slated for plan year 2028, a slight delay from the initial 2027 proposal. This is a game changer for affordability and access, Aria. Following the expiration of enhanced tax credits, approximately 10% of enrollees dropped their plans in 2026. This move by CMS directly addresses those gaps, broadening options, potentially increasing competition, and offering more affordable coverage, particularly for price-sensitive consumers.
Affordable and accessible, Dorian, or illusory and risky. Let's be unequivocally clear. Non-network plans as QHPs introduce substantial actuarial and regulatory challenges. What are the pricing methodologies for risk rating a plan where the carrier has no negotiated provider discounts and limited control over utilization? This is a recipe for adverse selection. If these plans offer lower premiums due to a lack of network override, they risk attract a disproportionate share of sicker individuals who prioritize cost over network access, or conversely, exceptionally healthy individuals who rarely utilize care.
The market needs options, Aria.
Innovation without robust risk management is reckless. The actuarial integrity of the exchanges depends on stable risk pools, and introducing plans without network cost controls or managed care oversight is a direct threat to that stability. We need to see the specifics on how CMS and state DOIs will mitigate the inevitable adverse selection and consumer protection issues.
Time will tell, but the market will adapt.
And the solvency ratios will reflect that adaptation. Finally, let's talk about a growing trend in employee benefits that directly impacts retention and return-to-office initiatives. New research from EaseCater, a corporate catering marketplace, published yesterday, June 10th, reveals a significant increase in employer spending on meal programs. 1 in 5 workplaces plans to boost their meal program spending by over 25% this year. A whopping 91% of workplace orderers intend to spend the same or more on food in 2026, up from 82% in 2024. The data is clear. Among hybrid employees, 79% report that employer-provided food would make them more likely to stay with a company enforcing an on-site mandate. This isn't just a perk, Aria. It's a strategic investment in employee well-being, engagement, and a powerful lever for RTO success.
A tangible demonstration, Dorian, or a fiscally unsustainable short-term incentive with questionable ROI from a P&L perspective. While I appreciate the intent to boost morale and RTO, we need to analyze the actuarial value and tax implications of these programs. Are companies tracking the actual productivity gains and long-term retention improvements, or simply RTO compliance? This isn't a direct group insurance product, but it consumes budget that could otherwise be allocated to core benefits or direct compensation.
It's about culture, Aria.
A positive workplace culture, supported by benefits like meal programs, directly impacts stress levels, health, and overall productivity, which does feed into health and productivity metrics relevant to other group benefits. It's an investment in the human capital. An investment that needs rigorous financial and compliance oversight. The P&L impacts extend beyond the catering invoice. We must evaluate the true long-term value against the immediate quantifiable costs and the potential for regulatory or tax exposure.
It's a competitive market for talent. Employers are adopting.
And actuaries are quantifying the true cost of that adaptation. And that wraps up another dense, data-driven edition of Group Insurance Daily Pulse. From targeted final expense products and the double-edged sword of AI adoption to radical shifts in ACA plans and the evolving landscape of employee perks, the industry is in constant motion.
Indeed, Aria. The strategic opportunities are immense for those who can navigate these changes, embrace innovation, and prioritize employee experience. The future is here, and it's exhilarating.
Exhilarating, Dorian, but not without its inherent risks. As always, keep a keen eye on your P&L, your regulatory compliance, and your solvency ratios.
And keep innovating for market share and employee retention.
For Group Insurance Daily Pulse, I'm Aria, the Actuary.
And I'm Dorian, the Distribution Expert.
We'll see you next time.